Hey traders, Corey Mitchell here with TradeThatSwing.com. I was asked recently about a swing trading log for stock traders. So this Excel spreadsheet incorporates a lot of the things and a lot of the statistics that I think are worthwhile tracking. So this is for stock swing traders who are looking for ways to improve their trading, can highlight the Excel spreadsheet, highlights problem areas, and then we can bring those to our attention and potentially improve on them. So I'm going to go through this, and most of it's automated, which is beautiful. So we really don't have a lot that you need to put in. Manually, you need to put in your entry date, like when you open the trade, your closing day, the symbol, and your starting balance. Then this one is automatically calculated for you, but it's how much we want to risk of our account per trade. This is not how much we put into a trade. How much we put into a trade is over here, but this is how much are we willing to lose of our total account. So a very common thing is to risk 1% of the account. So I have put here R equals 1% of starting balance, SB. So if we have a $100,000 account and we risk 1% of it per trade, that means we can lose $1,000. Now if we're risking $1,000, we always want to be making more. So I have these other things over here that look at projected target, our potential profit, our potential risk. So this is just R. If we're risking 1 R, that means we're risking $1,000. Our potential R profit. Oh, and R is simply the entry point divided by our stop loss, or difference between our entry point and stop loss, multiplied by the amount that we're putting into the trade. So if you click on any one of these, you'll be able to see the formula for how it's calculated. And this is really handy because since it's all automated, if you're not exactly sure how much to put into a trade, then this can help you out. So let's say just off the top of your head, you're like, I'm going to put 26,000 into this one. Ooh, that lets you know your R is a little high. You're risking well over the 1,000 you should be. Because it's pretty simple numbers here, we can see if you were supposed to be risking 1,000 and your R is 1.3, that means you're risking 1,300. So we're going to have to drop that down. So you can just experiment and see what your ideal position size should be. We're getting closer, 1.1, 20,000. Oh, okay, perfect. If we put 20,000 into this trade with a stop loss at 95 and an entry point at 100, we will risk 1 R or $1,000 of our account. If we're comfortable with that, we know that if the trade turns out well, I've put in a profit target of 120 here. I have articles on the site on how to set profit targets, and it's also covered in my complete method swing trading course. Then we're going to make 4R, or 4 times this amount, 4,000. So really nice. These are simply the percentage differences between our entries and projected targets. So initial risk percent, that's our entry point, minus our stop loss price is 5%. Potential profit, entry point to projected target, 20%. Profit loss percent. This is our actual amount that we end up winning or losing on the trade. And this is automatically calculated as well once we put in our actual entry point. So if you see I click out of this cell, then our profit percent and our target go to 0 because it's our actual exit point right here is 0 at the moment. So if we put in 120, which is where we get out of the trade, then you can see this fills all in. We get our 20% profit. That's what we wanted to make on this trade. Then we have a $4,000 profit, which is simply 20% times the amount we put into the trade. The fees column you can delete if you want. It's not particularly necessary if you don't pay fees. At the same time, you could also just leave it. There are a couple formulas tied to net profit, and you just have to tie those to profit if you wanted. So yeah, you could just squeeze these columns together if you didn't really need them. And actual R. So this is how much we made on the trade represented as R. I like dealing in R because instead of saying, oh, I lost $1,022, and on this trade I lost $1,037. On this one I made $5,000. I always want to compare it to what I was supposed to be risking, which is 1% of the account. So you notice your account balance changes. So if this trade is profitable and I made $4,000, now my account balance less fees is now up to $103,098. 1% of that is a little bit more. This is what allows you to increase your account over time or compound it, because you're making gains on gains you've already made. And you don't have to do that, but we can see here. So 1,040 is still 1 R of my account at that time, even though if I lost on this trade, I would have lost $40 more than the prior trade. In terms of the percentage of the account, those two losses are equal. And so that's why I like to keep things in terms of R, because as account balances change, we know what we're dealing with, and we know that we're always dealing with 1% of whatever our account balance is at the time. So this is the actual R profit, and you can see the formula there. R5, which is our profit, divided by E5, which is what we should be risking on that trade. Here we have a negative trade where we lost 1,280. Based on the stuff I put in here, I should have only lost 1,040. So I actually ended up losing about 20% more, an extra $200 out of $1,000 that I shouldn't have lost. And who knows, maybe this was a mistake. As you can see here, I entered at 100, or just sample data, put a stop loss at 95, and I actually ended up getting out of the trade at 94. So maybe I pulled my stop loss, maybe there was a little gap in the price, maybe, who knows what happened, but for whatever reason, I got out of this trade later than I was supposed to, which means I lost more money. Going to these final things over here, I'm going to skip to efficiency right now, because efficiency is how well I executed the trade based on my strategy or the plan I had for that trade. So when I took this trade, I was saying I'm getting in at 100, and I'm either going to get out at 125 or out at 95. Instead, I got out at 94, which made me lose an extra $200, and my R is now negative 1.2. So efficiency tells me how well I executed that trade. I executed it decently. I still got out pretty close to 1R, but it wasn't perfect. So I'll deduct that 20% from what would otherwise be 100% efficiency, and I'll give myself an 80% efficiency score. And this just over time lets me know how far am I deviating from what I was expecting for the trade, or how far did I deviate from what I was supposed to do based on my strategy. It doesn't matter if you win or lose. If this was a losing trade and I got out at, very close to my $95 stop loss, and I lost 1R, and I followed my rules that I'm supposed to according to my strategy, that's 100%. If I take a trade, no matter whether I win or lose, if I take a trade that's random and I don't have a strategy for it, maybe I saw someone on the news talking about a stock and I just jump into it, that is a 0% efficiency trade. I have absolutely no idea what I'm doing, and I have no business being in that trade. So efficiency, if we're honest with ourselves, tells us how accurately, how precisely we're following our strategy. And we want that efficiency up 70, 80% plus. If we're below that, it's probably not our strategy that's the problem, if we even have one. It's our discipline. We are taking trades we're not supposed to be in. We're taking trades that we have no strategy for, that we have no basis for whether it's actually going to make money or not. And so that's what efficiency tracks. So it's a pretty crude metric, but when you start seeing trades at 0%, 5%, 20%, that tells us something really went wrong. And if we went, let's say I pulled my stop loss and I got out of this at 90, and I ended up losing way more than I was supposed to. So I lost basically double. At that point, at double, I'm getting pretty close to 0%. Like I was supposed to lose 1, and I doubled that, so it's almost like 100% extra loss over what I was supposed to. So that would drop it down to 0. If you were kind of around, let's say you got a 93, you lost an extra 40%, so we'd put that maybe at like 60% or something like that. So you don't need an exact, but it's kind of whatever my extra loss is, I will add or deduct from 100%. And same with the profit. Let's say I was supposed to get out of this at 120, but I lost my nerve and instead I got out at 110. That's going to drop my efficiency to 50%. I did not know there was a formula in there. That's cool. Oh yeah, this divided by what it's supposed to be. So yeah, there is a formula in there. I'm not sure if it'll always work. I would probably put this in manually, just based on how far off you were of what you were supposed to do based on the strategy. So this has, again, nothing to do with winning and losing. How far did you deviate from the strategy? That's all this cares about. Because as far as I'm concerned, as a trader, if I was going to hire traders, I would rather hire people who can follow a strategy. Because if you can follow a strategy, even if you're following a losing strategy right now, if you can learn to follow a method, as soon as someone puts a winning strategy in your hands, you'll be able to make money. Whereas someone who maybe is making money off and on, but they do not know how to follow a strategy, that person is a ticking time bomb to me. I would not want them trading my money. Days in the trade. This is calculated automatically for you once you put in the entry date and the closing date. And we can see 11 days. This is total days, not just trading days. But to me, it doesn't really matter. I'm thinking about time in months, weeks anyway. So we can see March 1st to March 12th, about 11 trading days. This is helpful because then we can allocate our capital a little bit better. If all our capital is deployed right now and we're seeing some great trading opportunities that may come up in a few days, if we know that most of our trades are going to be done by then we know that capital is going to come available and we'll have some money to take that trade. If we know all these trades that we're in are probably going to take 3 months, then we have a decision to make. Are we going to pull some money out of current trades to put into these new ones that we're seeing? Knowing how long you're in trades can help you manage your capital a little bit better. And I'm not saying one way is better than the other in terms of pulling out money to put in other trades. Just those are the decisions you have to make, and this data can help you. Expectancy. Let's go along the top here. These are really what all this is about. We've calculated all this data. You've only had to put in a few things, and the rest is calculated for you. Expectancy is how much are we going to make per trade. So this is simply our win rate times our average profit minus our average loss minus our losing rate. So it gives us an estimate of what we can expect to make per trade that we take. Obviously, the higher this number is, the better. If it's close to 0 or negative, that means every trade you take, you're likely to decrease your account value. If the expectancy R is positive, it means that every trade you take, you're likely to be able to increase your account balance. Or there is a probability based on all the trades you've taken and the data that's been collected that your account will increase based on each trade. I'm going to change these back to what they were here. Yeah, so that one would have to be manually put in. Just so you can kind of see how these numbers, but no matter what, you'll be able to see them change. So as I was typing those in, you may have seen these numbers along the top change. And so expectancy we already talked about. Average R profit, if you look over here, there are some things that I say you don't need to touch these. because they're just pulling values from over here. So you have your profit and losses, and this one's just pulling out all the positive numbers, and this one's just pulling out all the negative numbers, and then those are used to calculate our average R profit. So we had a 4R win and a 6R win. Our average for those two is 5, and we had a 1R loss. That was actually originally, I think, there. So we can see, yeah, let's change it. We lost a little bit more than we were supposed to. So we have a 1.2R loss. And since there's only one of them right now, it's taking this divided by how many trades we had, 1. And so we get a reward to risk of about 4 to 1. And that's quite good. And then our win rate is calculated over here. So our wins, when we have a winning trade, we're just going to put a 1 in the win column. When we have a losing trade, we're going to put a 1 in the losing column. And these just all get added up, and it's just taking your wins divided by your total number of trades. So right now we've had 2 wins and 1 loss. We're at 66%. So this is a efficient way to track a lot of data and highlight areas where we have potential issues. And these are going to highlight the most, because if our average reward to risk is really low, we're going to need a high win rate, which is harder to do, to be profitable. If we have a really low win rate, that could also be an issue if our reward to risk is maybe 2 to 1 or 3 to 1. And so oftentimes we can just find what we need to do a little bit better. If our win rate's really low, we might need to work on our entry point or our stop loss placement. If our average reward to risk is mediocre, then we might need to look at what's happening after I get out of the trade. Is there actually more profit, or am I just scared? And how am I going to be able to extract more of that profit? Can I expand my profit targets? Maybe I can use a trailing stop loss. But yeah, a lot of things just come down to these factors here. We also really want to look at our potential versus what we actually end up with. If we're always setting a profit target at 20% above, but then we bail on that trade with a 10% profit, while we were expecting a 4 to 1 profit, if we only ended up with 2, that might be okay on the odd trade, but if we're doing it all the time and we're in this 50% area, we only captured 50% of the profit we were supposed to, that's going to hurt. Our risk reward's going to start dropping, and over time we could slip into negative. So we really got to watch these numbers and make sure that our expectations aren't overblown, that we're going into a trade with solid expectations about what should happen, and then we're following through on those expectations and executing our trades well. Talked about how you can change the amount to see how much you're risking in terms of R. That's kind of helpful, just so you make sure your position size is correct. These at the bottom, I have amount traded comes up right because these are just all blank. So this is just a number you can brag to your friends about how much capital you traded in a year. And a lot of these other ones where they have the div errors, and that's just because I've expanded the formula all the way down so that as you punch in numbers, they just automatically fill in. But until then, these are all zeros, so it's trying to divide by a 0 or whatever, so it gives an error. And if you want to see these, you can see I only have these up to, right now they only include the ones where there is data. If you start to add more trades in, then right now we're on line 7. So let's use net profit T5, 6, 7. So this formula is only including T5, 6, 7. If once you add more trades and maybe you're up to row 13, you can sum up all those trades that you have in, and you won't get an error because there will actually be data in there. But if we try to do that now, we'll just get an error. So because it's, there's no data there. So that's how we use those. At the bottom of the trade, there's basically 2 pages. This is just copied and pasted one to the other. And let's say you trade US and Canadian stocks, I would say keep them separate because one's using a different currency than the other. And so I'll track my Canadian stocks here, US stocks on this page. And the Canadian stocks, another reason to separate them is if you're trading different markets, the US, a lot more volume than most other markets in the world. Higher price stocks, trading the Canadian Stock Exchange, you're going to have much lower volume on most stocks, lower prices, and you may find you trade better in one environment or the other. So if your CAD shows that you're making a killing and your net profit's way up, and you have $100,000 in your US account and it's kind of lagging and you're not doing so good, or maybe vice versa, you're not really doing good in Canada but you're doing good in the US, that's good information to know. You're kind of spinning your wheels in one market. Why not put more capital into the other where you're actually making money? It might suit your style of trading a little bit better. So this is all just information you can use to get better. I've tried to make it as simple as possible so that you don't have to punch in all this stuff. It's all just calculated for you, and you can go through it, add in your trades, and see where there's potential areas and where you're falling a little bit short. So until next time, I hope this helps you out, and happy trading.